Krishna, the last few weeks, most VCs we've been talking to have been pretty pessimistic, focusing on a lot on terms like unit economics, cash burn. But we have a voice on the show who is more optimistic than the others, possibly because he's also an entrepreneur and an investor. We're talking about K Ganesh, one of India's most successful serial entrepreneurs and investors, and he now has investment companies such as Big Basket, Bluestone, and remember, he also runs Portia Medical. Mr. Ganesh, great having you on the show. Thank you so much. Take us, wear your hat both as an entrepreneur and an investor. Take us through your own sense of the current environment, because a sense of caution has set in, hasn't it?
No, I think this entire concept of gloom and doom now is as overstated as last year's euphoria was overstated. So I think there are three different aspects to it. One, there is a bear cycle. We do see softening in valuation. The amount of capital available for the startup ecosystem has come down because some of the hedge funds, foreign players who came in to play in the Series B, Series C stage have stopped coming in. So there is a reduction in the capital available, especially for Series B, Series C. There is a softening in terms of the valuations. They are not what it was. So that is a fact. Beyond that, there is absolutely no reason for this gloom and doom and deep depression that seems to be affecting everybody in the ecosystem. People talk about how some startups are firing people, employees, they are downsizing, reducing the number of cities. All that, if you see, is a small fraction of the total hiring that took place last year, small fraction of this total startup activity. So it is not really reflective and it's not statistically significant. Similarly, Fidelity marked down its valuation of certain startups. Morgan Stanley marked down. Again, this is a private mutual fund marking down a valuation. Was there a valuation run up last year? Yes. Did they overpay at that valuation? Perhaps yes. Has it come down? Yes. Does it mean is there a bubble? 100% not. There's an actual transaction taking place, growth taking place, real pain points being solved. All of it is robust and good. Is not going to go away. Your buying online is going to happen. People are going to use internet more and more for products and services. That is going to happen. Prices will correct like in public markets it corrects. So I'm not a subscriber to this gloom and doom theory. I'm very bullish, especially if you look at angel stage, Series A stage. Lot more funds have raised money. Lot more funds is available now. But we have to temper down our expectation to lower quantum of funding at a lower valuation than what we would have raised last year. But that's perfectly fine.
All right, Ganesh, this is Krishna coming to you from 18 Hours Mumbai studios. I want to ask you this. All the fears about valuations, sort of emerge around one particular subsect of the startup ecosystem, the food tech space. So tell us, what's your take? Is the worst over for food tech as a space?
No, I think certain models which got funded, certain models which got executed, startups that got started in the last year boom phase without solid unit economics, okay, right, will face a major challenge, okay, right. They should not have started, first of all, with that model. In a normal times, they wouldn't have started. In the euphoric times, they not only started, got funded. So they will be, food tech is one of them. For example, in the food tech model, if you take the delivery model, where people deliver food made by restaurants, the aggregator model, there is no business model. You cannot, the cost of delivery is 60 rupees to 75 rupees. You cannot sell somebody else's food for 200, 250 rupees, make 10% or 15% money, which is about 30, 40 rupees per order, but spend 75 rupees in delivery. You lose money per order on every order, even without cost of acquisition. So there is absolutely no business model. Similarly, like the fresh menu model, if you take the full service food restaurants, in the full service food restaurants, you have a challenge that unless your order value is more than 300 rupees, you will never be able to make money. So the companies that shut down in the food space are all companies that were delivering lower end food where the order value was 100 or 150 rupees. There, even with 50% margin, your cost of delivery will not get recovered. Forget about cost of marketing. So those are always unsustainable business models, I think that they have no place in the startup ecosystem to be there. It got funded in a euphoric time. I think those models are over. Strong models where, like the actual internet-only cloud restaurant model, where the order value is more than 300, it's a full stack food business, will thrive.
All right, Ganesh, we will leave it at that. K Ganesh, co-founder GrowthStory, and of course, serial entrepreneur. Thank you so much for taking time out to be with us here on ET Now, Startup Central.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.